Hey there, everyone. Dave Keller here with Market Misbehavior. I'm the president and chief strategist of Sierra Alpha Research, and I am so thankful to be back here in Redmond, Washington, bringing my weekly show here on StockCharts TV. Did not have a show last week. We were out on vacation all last week up in British Columbia with my family. All the Kellers flew in from around North America. We had an awesome time hiking, eating, talking, laughing, playing games, whitewater rafting, floating down rivers, having a blast. What a wonderful part of the country. I've heard from a number of you from Canada when I posted on social media that I was heading up to BC. And I tell you what, just some of the genuinely nicest human beings on this planet, to be honest with you. We absolutely loved it. Natural beauty, but really warm and welcoming people as well. So we enjoyed it a great deal. However, drove about 8 hours yesterday to get back here to Redmond, and super excited to be back, and hopefully better than ever. I missed also my July 2025 get-together with Grayson Rose, where we usually get together once a month and do our top 10 charts to watch. He posted a solo video last week. It was awesome. I would highly recommend you check that out. We've enjoyed doing that collaboratively every month, getting together in the studio, talking about charts, talking about techniques and approaches, and how to leverage the StockCharts platform. Grayson did a great job doing that by himself last week, so I would encourage you to check it out. I had some stocks on my mind, so I thought it would be helpful to pivot a little bit, do kind of a similar vibe, but sort of give myself a bit of a creative restriction. So what I'm going to do is highlight 10 stocks that I'm watching here, but focus on one per sector. A lot of times what you'll find is, my conversation with Grayson, we kind of naturally gravitate to certain sectors, right? Because at a particular part in the cycle, maybe industrials and materials look good, or financials, or technology. And so we often have a number of picks in specific sectors. And the sectors where our ideas tend to be focused can be a signal in its own, right? Sort of see what sectors and what themes kind of emerge when you're looking for good charts. But sometimes it's also helpful to, try to identify top performers in each category. In this case, we'll do it by sector, which forces you to not just go all in on technology or on one particular theme, but force yourself to find opportunities across the 11 S&P sectors. I like the number 10, so we're going to skip real estate. I found coming up with individual ideas in the REIT space pretty not helpful, because I don't have a lot of people stock picking within a real estate. You kind of have a real estate exposure if you want, which is fine. I think that's a good way to diversify your portfolio. So we're going to skip REITs and go to the other 10 S&P 500 sectors, one stock per sector. What chart looks interesting and why? I'm going to show you the 10 charts that I came up with. I'll show you how I found them, and let's kick it off here with DoorDash. So I tend to think of the sectors alphabetically, and so I start with communication services. There's probably a more thoughtful way to do it, and to be honest with you, a lot of times when I'm looking at the 11 sectors, I group them by category. So I'll do the 3 growth sectors: technology, consumer discretionary, communication services. I'll group the defensive sectors like healthcare, real estate, and utilities together. But here we're doing alphabetically, which is how it normally kind of gets sorted, and that's how I've done it for years, and I'm not changing. So here we go. DoorDash is number 1. There are actually a number of interesting charts in the communication services sector. I don't think it's that hard to find them, and I almost went with some of the big Mag 7 names like Netflix and Meta, 2 of which I would say look very similar to DoorDash in terms of the fact that the moving averages are in the proper order. We'll come back to that later. The 21-day EMA is above the 50-day moving average. The 50-day simple moving average is above the 200-day. They're all sloping upwards. That's kind of the ideal chart. If I can build a portfolio around charts that look kind of like that, I'm feeling pretty good about my portfolio at that given time. So what I think differentiates DoorDash here is the fact that while some stocks have shown bearish divergences, we've actually not seen that with DoorDash. We've seen new highs going into July on stronger momentum. I think that's pretty encouraging. Besides being above the 21-day moving average, I would say also we're broken above price resistance. So the February high was right around 215. You can see we retested that at the end of May and broke slightly above there up to 220, but then finally emerged and continued to make new highs. Most important part of this chart, I would argue, is the improving relative strength. The relative strength chopped around a bit in early May because it was pulling back while the major averages were really accelerating to the upside. However, that pullback, instead of accelerating further to test the 200-day, actually found support and then reinitiated the uptrend phase, which has continued through last week. So overall, I would say DoorDash is kind of an idealized chart, making higher highs, making higher lows above upward sloping moving averages. They're all in the proper order, improving relative strength. It's kind of a decent chart all around. All right, within the consumer discretionary sector, again, a number of interesting charts that I could have shared with you. I went with Booking Holdings, BKNG. Maybe this is because I just got back from a trip where we're using a number of different apps to book hotels. We kind of went with we had an Airbnb booked, so I maybe should have looked at that stock first. We actually didn't use Booking.com now that I think about it in particular, but we did use a lot of apps, right, in terms of figuring out hotels. We had an Airbnb reserved up in British Columbia, but to get from Redmond up to Windermere, it's about a 10-hour drive. And so we broke it up into 2 days. We kind of picked a hotel along the way, thought about how tired we were, and so just did it on apps. And I mean, boy, we talk about a pretty painless experience. Didn't have to talk to anyone. Showed up at the hotel hours later. Room's ready. Everything's ready. We're all checked in. Pretty awesome. So the technology is certainly pretty powerful. I would say from a technical perspective, what's interesting about the chart of Booking, kind of similar to this previous chart of DoorDash, where you had a resistance earlier this year. Booking actually had resistance in December of 2024. Then we had a potential retest in February, which did not go well because we then rolled and made a new 3-month low soon afterwards. So getting above that general range, which for Booking.com is kind of in the 52 to 5,300 range, was important. I don't have it drawn here, but if you take a horizontal kind of a rectangle from, I'm on StockCharts. I can draw lines. I'm doing it. What I like to do, instead of drawing a line for something like this, is draw a range. This was an Arthur Hill trick. He showed me this years ago when I was trying to learn the StockCharts platform. I'd used other institutional platforms when I worked at big money managers. I broke off on my own and was asking for help from contacts that I thought were really good chartists. Arthur Hill was top of mind, and he showed me some tools and techniques to make the StockCharts platform sing. So as always, special thanks to Arthur, to Tom Boley for giving me ideas, Greg Schnell, the late Greg Schnell, giving me a lot of really good ideas as well. So with the chart of Booking, when we draw a rectangle, what we're doing is saying there's not just a specific level, but it's more of a support or resistance range, right? And so a rectangle shape kind of gives you a little more room. And then what you do is you don't make it an opaque color. You actually make it a little more transparent so you can still see the price action below. And you get this kind of really, really beautiful, support range or resistance range. So now we can see how the December 2024 peak lines up pretty well with that retest in February of this year. We can see the breakout in May was so meaningful, and then the pullback to that area. See how that lines up so well? And now we've broken higher, similar to the previous chart. Moving averages all in a proper order. 21-day above the 50-day, which is above the 200-day. They're all sloping higher. The stock's making a new 52-week high in the last week. This is a chart making higher highs and higher lows. And so I would say the fact that, again, no bearish divergence, relative strength pretty good, moving averages strong. This is a stock showing some upside potential now going into pretty busy travel months here in July and August. All right, third sector is consumer staples. This is a more defensive sector. I would say generally less ideas that looked awesome versus the first two sectors, which are more growthy offensive sectors. However, there are still charts that are valuable, and I think if you do one of these exercises on your own, right, pick one stock in each of the 11 sectors, I think what you'll find is even in very bullish markets or even in very bearish markets, you will tend to be able to find at least an idea in each of the 11 S&P sectors. That is something I have very much learned over the course of my career, working with some really successful stock pickers where the game was less thinking about their sector allocations and more about just finding good ideas in any sector. And I learned that there were opportunities often places where you wouldn't expect. I wouldn't expect with the market in the position that it's in to find a lot of great ideas in consumer staples. I don't find a ton of them, But I am finding some, and I would highlight here the tobacco stocks, right? Phillip Morris and Altria, ticker MO, both look pretty strong. I've selected Phillip Morris here to highlight for you. It actually recently pulled back to an ascending 50-day moving average, but so far going into this week, bouncing off of that support level. What I wanted to highlight on this particular chart is the momentum. I'm a big fan of what they call the range rules with RSI and other momentum indicators, which means in a bullish phase, the whole range of the RSI tends to drift higher. In a bearish market phase, the whole range of the RSI tends to slope lower. So here we can see that the range has bumped higher. The pullbacks that we saw in April and in May saw the RSI remain above the 40 level, which is crucial. Most recently, we've had a pullback to an ascending 50-day moving average. The RSI has held 40 as well. Those pullbacks making higher lows where the momentum stays above 40, this is the RSI that we're using, often really good buyable dips within an uptrend phase. So tobacco stocks have been one of the better places in consumer staples in 2025. You can see that they've outperformed the S&P year to date, which not many consumer staple stocks have done. But I think the momentum features of Phillip Morris makes it a pretty compelling chart right about now. All right, within energy, a little tougher because a lot of the energy stocks struggling a bit here as crude oil prices have chopped around quite a bit, right? You had the spike higher in crude oil prices when the events in the Middle East escalated between Israel and Iran. As things have cooled off and there have been less violence, hopefully much less going forward. Crude oil prices have settled back down as it looked like supply was not going to be disrupted as much as maybe initially expected, given the conflict, the rise in conflict in the region. I would say, though, one of the big areas of focus for me in the energy sector over the last year has been infrastructure names, which you have to remember the energy sector has a number of different themes all tied to energy use, and energy supply, but with different businesses, right? A lot of companies make business on drilling oil out of the land, right, from underneath where we live. And those are the big integrated oil companies. Those are the big oil producers and explorers. But you also have pipeline companies, and that's what I'm highlighting here with Kinder Morgan, ticker KMI. This is what we call an energy infrastructure name. These are the companies that actually get the oil from where it comes out of the ground to you in your car somewhere and gets it to a gas station where you're going to actually be using it. So Kinder Morgan kind of provides the energy infrastructure, and these are stocks that have generally done a lot better because they're less sensitive to the price of crude oil. They're more a service that these oil companies will need. And I would say with KMI, what's helpful about this stock is the dividend. What you'll notice about pipeline companies, as long as the price holds up, and I'm looking at the unadjusted version of this chart, which I'll talk about in a moment. But as long as the price holds up, you're not losing much on the price of the stock, but you're gaining a pretty decent dividend yield. So stock price has remained steady. You're getting about a 4% dividend yield, which looks pretty good compared to other sources of income, and certainly a higher yielding stock than the average in the S&P 500. So I think the defensive nature of this type of name, the fact that infrastructure, I think, still is a good opportunity in the U.S., makes KMI a compelling idea in my opinion. I think one of the things to note with this, and you'll note this on a couple charts, I've looked at the unadjusted data set, and you can see that after the name of the company here on StockCharts. There's two ways you can take an adjusted data set and turn it into an unadjusted data set. This is the adjusted data, the normal default on the StockCharts platform. To change it to the unadjusted data, you put a little underscore before the ticker, or below the price, you'll see this guy that says adjust for dividends. So you want to make sure that is deselected, that you've unchecked. And now you're looking at the raw price data going back. The reason why you might want to do that is because of a higher yielding name. Every time the company pays a dividend, the adjusted data set adjusts all the previous data, because when a stock pays a dividend, it's actually taken away from the price of the stock. So the price of the stock goes down, the amount that the dividend is paid out. That's how that actually works. So a lot of times technical analysts like to look at adjusted data because then it eliminates those kind of artificial price gaps and lets you focus just on fear and greed, the emotional drivers of price patterns and certainly technical indicators. So that's why it's defaulted to that version on StockCharts. If you use other platforms, you should check because they have different methodologies. Every platform's kind of on their own to determine how they want to show you the data. But I'm a fan of the way that StockCharts does it, specifically how easy it is to pivot between adjusted and unadjusted data sets. So on a higher yielding name, I usually look at the unadjusted data just so I can look at more pure price analysis and then think about other things in relation to that price. Again, we can see the moving averages are in the correct order, the 21-day above the 50-day, 50-day above the 200-day. As long as that stays true, decent yield, chart holding up, infrastructure play, I think that's a pretty compelling option. All right, we're now in the financial sector, which is more of a value-oriented sector. We're going to talk about Charles Schwab. I would say within the financial sector, you got a bunch of different themes to think about. I would say insurance companies concern me because a number of them are starting to break down. Progressive is one coming up on earnings later this month, and I would say just starting to potentially break down below the 200-day moving average. Big banks like Citigroup, JP Morgan, almost thought about those. A lot of those are very overextended after a pretty good run. Would not be surprised if we get a bit of a pullback in some of those names, which means I'm left to look at money managers like Charles Schwab as a particular group. I love the chart of SCHW, particularly how we broke above the November 24 and February 25 peaks. That was around $83 to $84. We finally broke above there in May. We sort of consolidated here from mid-May, really toward the end of June, and then just in the last week have broken up to new highs. So I think that breakout of this consolidation is pretty important. Right around here, I'm thinking, all right, either we break above 90, which would be very bullish, or we break below 86, which would be very bearish. We did the former. We broke above 90, which I see as a bullish tell. Breaking above, I would love to see a continuation on stronger momentum to validate that breakout. All right, within the healthcare sector, I'm highlighting Boston Scientific, ticker BSX. This is an interesting chart because I would say it's not quite ready. This is one that I would say it's a chart I'm watching. I would not say it's 100% ready yet, and I would say the reason is because we've recently pulled back from significant resistance. We can see the high in February of 2025 was retested in May and June, and then just at the end of June, we briefly broke to a new high above $107 and now have pulled back. I would want to see this break above that 107 to 108 range. I think this stock over 108 would be a really interesting one. That's why I have an alert set on StockCharts. I'll show you how to do that in a moment. Just making a reminder on a notepad to do that here before I forget. But what we can see on this kind of chart, right, you have a consolidation phase, right, sort of a basing pattern, a level of resistance that is held for about 6 months. On a chart like this, I like to be patient and wait for a break above resistance because that confirms that something is new, something is different. There's an influx of buyers. There's more demand than there was before. There's less the fear. There's just a lot more optimism. I would say at this point, it's still an open question. I think Boston Scientific above 108 would complete a breakout above resistance and signal a continuation of the trend. You can see the moving averages in this case are not anymore in a proper order because the 21-day is below the 50-day. I would love to see that resolved on that price breakout. So this is one that I think is important to highlight because we're waiting for a breakout. Now, if you have a chart like this and you want to set an alert, it's super simple. There's this orange button with the little alarm bell. You click on that. We'll actually do it right now. It automatically loads the stock BSX. It says crosses above, and I was looking at like 108, and I would say BSX break to new highs. Below there, okay. Below there, we can say email, text message, site notification. I like to pick all of those because I don't know where I'm going to be or what I'm going to be looking at when that moment happens. I just want to be aware of it. And so that's how I have it set up. Great way to analyze stocks, analyze charts, set an alert so that you don't have to be staring at the chart. Have the platform do some of the work for you. Now we're to industrials, one of the cyclical sectors, what we call economically sensitive value sectors, like financials and materials. Here in industrials, I like the aerospace names. These are stocks that have done particularly well as events in the Middle East have escalated, as there's been a lot of talk about European companies or countries, building out their defense capabilities in a way that we haven't seen. The U.S. appearing to be drawn into some of these conflicts. None of that tells me aerospace and defense companies should be struggling. This suggests to me additional investment in these stocks. This is a group of stocks that I'm very keen later this month on stocks like Raytheon, learning from the earnings calls what sort of expectations, how those might be increased given the escalation in the Middle East and elsewhere. From a technical perspective, this is a great chart. Once it broke above that March high, we saw a pullback, what's called a bearish engulfing pattern there in mid-May, a pullback to the 21-day EMA, which has held this support a number of times over the last couple months. Again, talking with Mike Webster on my podcast recently, he's sort of the brains behind a lot of the really cool features in Investors Business Daily, and we talked about the 21-day EMA in my podcast interview recently. And charts like this remind me what a great sort of short-term measure of support that can often be. For now, it's holding the 21-day EMA. They're all sloping upwards. They're in the right order. And I think as long as that continues, this is a strong chart appearing to get stronger. Now, the material sector is pretty interesting. I almost picked some steel companies like a Nucor, NUE, or something like that. But I just want to highlight on the chart of Mosaic, which is in the specialty chemicals group, the fact that we have what's called a bullish pennant pattern. A pennant pattern is when you have a big run higher, and then you have this consolidation, what's called a coil pattern. So an uptrend is a pattern of higher highs and higher lows. A consolidation pattern like this, a coil pattern, is lower highs and higher lows. So we're narrowing in. When the market has basically reached an equilibrium, the chart is telling you this stock's worth about $36 a share, and we're just kind of over and undershooting that value, kind of trading around that point. And what's great about this pattern, it is a great pattern to just sort of wait, sit on your hands, and wait to see which way it breaks. One of two things is going to happen, usually about 2/3 or 3/4 of the way through the pattern. Either we break above the upper trend line, which is what happened with the chart of Mosaic, or we break below the lower trend line, which would be a pretty bearish conclusion. We had the bullish conclusion with the break above the upper trend line. We've now broken above that early June high, which means a new 52-week high on a stock that absolutely struggled really into the April market low. This thing's making, retesting its low just above $22 a share from there. Lights out uptrend into early June. Consolidation pattern has now resolved to the upside. I think that's pretty encouraging. Only warning sign I would say on this one is the bearish divergence potentially with a breakout on weaker momentum. Let's see if we can get stronger momentum readings on further uptrend. But I would say overall that bullish pennant pattern is pretty compelling. All right, almost done. We've got two more sectors. Technology, I'm highlighting Uber. This is a good, year and a half long chart to highlight the fact that the highs from the first quarter of 2024 lined up pretty well with the October 2024 high. Look at this, what we call an exhaustion gap, a big gap higher after an uptrend. We immediately sell off. That tells you the uptrend is most likely over. We then find support around $60 a share off of the April low, which is a retest of that point. We finally break above that shaded area, kind of in the $82 to $84 range. We then pull back, and resistance now becomes support. We also bounced off the 50-day moving average, now accelerating to the upside. This is what we call an impulse gap or a breakaway gap, where we make a new move to the upside. We're now making 52-week highs today. Moving averages in the proper order. I think that's a strong chart, really starting to improve. I like Uber at this point. All right, final chart out of these 10, one per sector. How am I at DoorDash again? Hold on. Uber. Oh, I missed the last one. Okay, hold on. What was it? EVRG. Sorry about that. I had that all set up perfectly. There we go. EVRG. I'm going to save this to the chart list. Here's a tutorial on how to save something to a chart list. There we go. EVRG is a company called Evergy. This is a conventional electricity company based, I think, in Kansas City, if I remember right. So based in the Midwest. Basically, this is a play on utilities. Similar to what we saw with one of the big dividend payers. We want to look at unadjusted data because it's a high dividend name. It pays almost a 4% dividend. Which is dividend yield, which is pretty compelling. So looking at the unadjusted data set, we can see that this has actually been kind of sideways. Similar to one of the previous charts, I'm looking for a breakout. I think this is a really compelling chart. if we are able to secure a move above $70 a share. We tested that on Thursday's shortened holiday session. We've pulling back a little bit today to around 69. I think a push above $70 is a really good one. I'm going to set an alert there too. But what's interesting about this chart, again, it's holding up, but the fact that we pay a pretty strong dividend. So one of the ways you can cushion yourself from potential downside, if you're worried about all this tariff tantrum, if you think there's another leg lower for stocks given the uncertainty here at the as we get into July and get into earnings season, buying some low volatility, higher dividend paying names can be a really good way to, sort of cushion yourself from potential downside. These are stocks that tend to move down a lot less than big, higher beta, volatile names. So they're going to have less potential downside in price terms, but the fact that they pay a decent dividend means you're also getting that income component if the market would start to rotate lower. So having some dividend components in the portfolio, often thought of as a really good way to round things out, and I'm a big fan of that. And I would say if you're looking for sort of higher dividend pairs with constructive price action, EVRG is one of those utility companies that come to mind. So when I'm scanning in a sector like utilities, I often look for good dividends as well, just as a way to validate sort of a well-rounded stock to help round out my portfolio. There we go. That's 10 charts, one stock for each of 10 different sectors. I'm curious, did I not pick one of your favorite stocks in one of those sectors? I'd love to know which one I missed, in your opinion. Drop a comment below. Let me know which sector, which stock, and why you think it deserves a place on this top 10 list. As a reminder, I'd encourage you to check out Grayson Rose's top 10 charts to watch for July. Very well done, as always, and I will look forward to getting back in the studio with Grayson next month. Also, if you're looking for my market recap show, it is back and better than ever, called Chart This with Dave Keller. We run it every weekday after the close at 5 p.m. Eastern. You can find that on my YouTube channel called Market Misbehavior. Also, check out my Market Misbehavior podcast. I was able to interview Mike Webster, Callie Cox, some really good interviews here over the last couple weeks. They're all on my YouTube channel. Also, anywhere you get podcasts, Apple Podcasts, Spotify, it's there as well. So I hope you can check those out. Share it with your friends if you would. That's it for today. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts.